Welcome to Talk Tickers. Today, we're breaking down the third quarter 2025 earnings call for Modiv Industrial. That's ticker MDV. We're going to get into the numbers, unpack their strategy, and give you our take on what's next for the stock. Let's jump right in. All right, here's the plan. We'll hit the Q3 results first. Then we'll dive into their pretty unique Cockroach strategy. After that, we'll put it all into context with the broader REIT sector and wrap it up with our forward-looking view on the company. So Modiv themselves called this quarter boring but profitable. And you know what? The market seemed to agree. The stock barely budged. So let's break down the numbers and see exactly why that was. Okay, when you look at a REIT, the number you really want to focus on is AFFO. That's adjusted funds from operations. It's a much better gauge of actual cash flow than your standard earnings per share. And on that front, Modiv delivered a solid beat, coming in at 36 cents a share, which was 2 cents better than what the street was expecting. Now, they pulled this off by keeping a tight lid on costs, even as revenue came in pretty much right on the money. And that right there is why the market kind of shrugged off the flat gap EPS. The AFFO beat is the real story here. Now, those steady, kind of boring results, they are absolutely not an accident. They're actually the direct result of a very deliberate strategy, one that management has colorfully named the Cockroach approach. And it's all about durability over flashy, risky growth. And, well, you really can't get much clearer than this. In the CEO's own words, the entire goal is to be indestructible. The strategy is not about chasing the next hot trend. It's about building a fortress-like balance sheet that can weather pretty much any economic storm you can throw at it. And here's what that fortress actually looks like in practice. 100% of their debt is locked in at a fixed rate, and a really attractive one, at just under 4.3%. But here's the critical piece. They have no debt coming due until 2027. That gives them a massive runway. You add in stable leverage and almost $40 million in liquidity, and what you get is flexibility, the power to be patient and opportunistic when others can't. So you might be asking yourself, if they're not taking on a bunch of new debt, how exactly are they going to grow? And that's a great question. The answer is this playbook right here, asset recycling. Basically, they've identified about $150 million worth of properties that aren't performing as well as they'd like. The plan is to sell those off, take the cash, and reinvest it into new industrial properties that have higher yields. It's a really smart way to grow cash flow internally without having to dilute shareholders by issuing new stock. Okay, so we've got the company's internal game plan down. Now, let's zoom out a little and see how Modiv fits into the bigger picture of the real estate market right now. So here's the thing. Despite that really solid, durable strategy, Modiv's stock has actually lagged the broader REIT benchmark over the last year. And this really highlights the market's mood right now. There's just a lot of caution around smaller cap REITs. They're often seen as being a bit riskier when the economic picture is uncertain. But, and this is a really big but, here's the trade-off. To compensate you for that underperformance and that perceived risk, investors are getting a dividend yield of over 8%. That's literally more than double the benchmark. So it's that classic high-yield proposition, right? You're getting paid very well to wait, but it comes with the risks you'd expect from a smaller, more concentrated company. Okay, so with the numbers, the strategy, and the market backdrop all laid out, it is time for our call on the stock. You know, the key question for investors really boils down to something pretty simple. Is that juicy 8% yield enough to pay you for the risk that management can't execute on their plan? They've laid out a very clear roadmap. Now they just have to deliver. So for us, we are initiating coverage with a market perform rating. The story here is just very balanced. On one side, that dividend is incredibly attractive, especially in this environment. But that's offset by the fact that this is a show-me story. Management has to prove that its asset recycling strategy can produce real results. So what should you be watching for? Well, in the short term, we see the stock pretty much trading sideways. The first little catalyst to watch for is them finally selling a vacant former Costco property. It's currently a $40,000 a month drag on their cash flow. But the real game changer, the primary catalyst, is going to be seeing them make real progress on that $150 million asset recycling plan. That's the big one. And then, hovering over everything, is the macro wildcard. If the Fed even hints at cutting interest rates, that's likely going to be a massive tailwind for the entire REIT sector, and Modiv would certainly get lifted up with it. And that just about wraps up our briefing, but there's one last important thing. This is not financial advice.